Welcome back. We're in conversation with S. Naren, CIO of ICICI Pro AMC. In the first segment, you kind of heard Naren lay out his solid, fundamental, sort of top-down setup in terms of how he sees things panning out in 23. Let's get specific now. Large caps, mid caps, small caps, sectoral preference, dislikes even. Naren, thanks for being with us. Large caps versus the rest of the caps, mid caps, small caps. You like large caps because they offer valuation comfort, I believe, right?
See, basically what has happened this year is the bulk of the selling. See, once you have selling, market corrects, then valuations become cheap. Let's look at where there was selling this year.
Right.
It happened by FIS.
Right.
Where did the FIS sell? They sold in large caps.
Right.
So large caps became the area where bulk of the selling has happened this year. So large caps became the area where valuation comfort is there to a higher extent.
Okay.
Mid cap and small cap, the mutual fund industry ensured that there was continuous SIPs.
Right.
So that area there's seen virtually no selling.
Right.
So those areas, the valuations are not cheap.
You're also in the past famous for calling out a segment which is looking frothy. Is it looking frothy, mid caps and small caps?
They're looking clearly costlier than large caps.
Okay.
Because see, you need some wave of selling for the valuations to correct.
Okay.
And there has been no wave of selling for years now.
Right.
So, and retail was also positive.
Right.
So that's not an area where we have seen any selling.
Right.
Once you see selling, the sector's valuations correct.
Right.
So that's why we prefer large caps over mid caps and small caps. We also like flexi caps.
Right.
Because what happens in flexi caps is at some point of time when you want to invest in mid and small, because mid and small are structural areas.
Correct.
So at that point of time, you can actually buy mid and small cap also.
Right.
So that's how we look at it.
And one area in the large cap space which has corrected a lot, we spoke about it earlier as well, is IT services, right?
Yeah.
One big sector which is down significantly still, you still like that?
See, our view is very simple. Both the export-oriented sectors, whether it is IT and pharma, both have done very badly in the last 1 year. If you look thematically, those are the two sectors which have done very badly. We think that both these sectors are worth systematically investing over the next 1 year because there is possibility of global recession. So you invest into the recession, you normally make money. Just like, people who invested in banking into all the banking problems they made a lot of money.
Yeah.
Something similar.
So buy a IT fund or?
Yeah, you can buy even an exports fund which covers both. Or you can buy a separate IT fund, technology fund, separate healthcare fund, pharma fund.
One hears about IT, but pharma is, I sometimes feel even more, although price damage may not be as much as IT, but pharma is kind of completely unloved right now.
So, it's in theoretically what you said were very, very sweet words. Unloved sectors are the right thematic funds. And we have always seen any unloved sector automatically means you find that you can make
eventually
money.
You make a lot of money. And it's not just export-oriented pharma. You like local Indian pharma names as well, right?
Both, because they all had this COVID base.
Right.
And after the COVID base, because of the COVID base, their next year turned out to be very bad.
Right.
So again, the sector turned out to have two benefits.
Right.
One, the COVID base resulted in a problem.
Right.
And the second is export.
Right.
So I think apparently there are companies, they already had an overdose of FDA inspection as well.
Right.
So I think between all these reasons, I think these two sectors, you can look at it either through the export route or separately, both pharma and technology.
Right.
These are very interesting systematic investing routes for the next.
The other area is consumer, which you like quite a bit, right? And what in consumer? Because it's a very wide...
See, actually valuations never correct. So we believe that consumption as a theme is a very interesting theme. But the problem is that the sector doesn't correct. But we think that one should look at the theme structurally over the next few years.
But which subsectors? I mean, because it's...
Broadly, it's best to look at the total theme because when you invest in the theme today, immediately maybe it's best to invest in sectors like pharma within the theme or telecom within the team or something like that. Consumer durables have been doing badly. Auto has been doing badly. So those are the themes which you will invest in now. Later when FMCG corrects or consumer durable correct or retailing correct, you will invest in those sectors at that point of time. So it's better to invest in a broader theme because one thing, if you think of a decade ahead, it's one of the themes which is bound to do well. because there is no way in which you're going to have a
Consumption
situation.
will not grow.
Yeah.
So exporters, IT pharma, and a basket of sort of consumer consumption names, right?
One of the other ways we are actually telling people to do is, macro investing is going to play a lot of role over the next 1 decade.
Okay.
In fact, our view has been that it is the Fed which controls everything in the world. So we actually pioneered this business cycle fund with a launch in 2021, and now every fund house has also launched it.
Right.
We think that top-down investing has a long road, because just imagine if the Fed comes and says, I'm going to cut rates.
Right.
Imagine what kind of a bull market gets created.
Correct.
So we think that macro investing through the business cycle route is another very good thematic way to continuously invest for the next decade, because it is finally macro which plays a role.
Right.
Did any of us expect that US markets will do badly? It was the Fed which brought down the US markets.
Yeah.
It will be the US Fed which actually again is going to take the US markets up, or in all the growth stocks up.
Okay.
So I think macro investing is going to be a very, very important thing. Element to investing over the next decade.
Okay. The other area which has seen a frenzied move is this entire PSU bank space. So I want to start there and then come to private banks. Any interest, any idea whether this could continue, in your opinion?
See, it's a very tough call. We were some of the people who actually, in many of the funds which I run, we made a lot of money out of PSUs. Most of the time when we invested, people asked us, will you ever make money in PSU stocks? Yeah. After they have run up, when people ask me this question, I don't know how to answer them, because tactically they look very good. Right. But you should ask, in 2020, the number of questions we were asked.
Why are you buying?
Why do you have PSU as your top holding? Right. Even today, where I have a PSU as my top holding in some of my stock funds that I run, top holding. And most of the time, including some of the younger people in my company, they ask me, how can you have a PSU as a top holding in your stock? Right. And they've all done so well. Right. And I have to answer my younger colleagues in my company, I have to answer distributors, I have to answer investors. And when they do well, people ask me, will they continue to do well?
No, you've not answered the question. What do you think? It's kind of, they've run up, right? Quite a bit. So
the point is, I'm essentially a contrarian.
Right.
So when something does very well, I 6 months back or 9 months back, when metals did very well, people asked me, would you buy metals? Right. I told them, no, I'll buy the user of metals. Right. So I'm not trained to give bullish call on something which is done very well. I'm trained to give bullish call on something which people believe is neglected. Like, for example, debt today. Right. Or tech and pharma today. Right. But I'm not trained to give bullish call on something which is done very well.
Private banks? What's
Private banks, I think, is a structural story. They have underperformed some of the PSU banks now.
Correct, exactly.
So, as long as interest rates are, as long as demand for credit is going up, the near term looks good. In the medium term, there can be some challenges. Right. So I tell people that the short term and long term is very good. Right. Medium term has some challenges. Okay.
You mentioned briefly metals, right? When you last on, you said don't buy producers but buy consumers. Yeah. Is that still the way you look at it, or is it reversed now?
See, metals have corrected a lot. And if there's a good, big China reopening, it becomes a tactical trade after the correction.
But that could be now, right?
It could be now. So structurally, I think tactically, it's an interesting sector to look at.
Okay. Steel, non-steel, the entire...
Both actually. And unlike 6 to 9 months back, there's no frenzy in the sector. No one talks about it.
Correct.
So that's how we look at it. So but is there 2020 to 22 moves in the sector? Unlikely. Unlikely.
Right. You got that. Defense is another area. It's a newer kind of thing. Although BL has been around for years, but now they've got so many other companies, right, in different facets of defense. Do you own any of these names? Do you like them?
Yeah, we do own a few of them. And again, it's part of the same PSU answer.
The question that
when some question you ask me at a 52-week high after a 100% move, I will tell you, I will think about it.
But you're not pairing. You're not pulling back, or I mean, that could be a decision.
It's not that the position, the sector being what it is, it's never a very big part of the portfolio.
Smaller.
These are all smaller parts.
Right.
So, you know, is it necessary to walk out of a small position is a question my colleagues and I discuss about.
Right.
But do you actually easily get in and say, after a big move, do you want to take a big position? It's not part of my mindset, but my growth-oriented investor colleagues, they think about it.
Do your growth-oriented colleagues think about new age companies?
I actually moderated many of my colleagues, and
You brought them around to your way of thinking.
No, I actually told them you have to take tactically smaller positions,
Right.
and it helped us a lot.
Right.
If you look at it in the last 1 year,
Yeah.
the fact that people, the old fogies like me, ensured that we took smaller positions. Helped us a lot because many of them corrected 50-60%.
Yeah.
And now we told them, look at everything with an open mind.
Okay.
And if you look at it, some of those new age companies, we would have our highest ever position today after a 50% fall, not 1 year back.
Which ones in particular, Naren?
We can't talk about stocks, but you will see it.
But
in
you're
our
saying
monthly.
that it is.
We have a much bigger position in some of those
these names now.
some
So
of
they've
these.
corrected enough.
They've corrected enough. The implied assumptions on all of them is much lower than what it was on the day of the IPO
Okay.
in some of them.
Okay. Anything else, Naren, which kind of catches your attention? Again, the unloved part of the market is what you like to look at. What else is unloved?
See, I think, 1 year back, we were worried about the new age companies, whether people were going overboard. Now people have to ask whether they are going overboard in some of the small and mid caps. But in the broader market, I think the risk of them making mistakes are lower now than a year back. But in the small and mid cap, people have to do simple questions. What is the trailing price to earnings? What is the trailing price to book? These are the two questions I tell people to ask. As long as they have that answer to that question, they are comfortable. They don't need to do any big analysis. And if there is a good dividend deal, these are the three questions I tell people to ask.
And in this kind of an environment, it's unlikely that multiples will expand meaningfully.
Yeah,
That it's kind of tough
unlikely
to
when
imagine.
interest rates are going up.
Right. So earnings have to do the heavy lifting.
Yeah.
So in that context, anything else any sectors, or is it very stock specific now? I mean,
Very stock specific now. But we would be more uncomfortable with big borrowers. I'm not talking of banks here because banks have a lending function.
Sure.
And we would be more comfortable with the cash-rich, cash-flow-oriented companies than with big borrowers.
Naren, any other themes that you want to look at? Any kind of idea, consumer users versus producers, anything like that, which you would like or avoid?
No, to summarize, what I would like to say is that people should believe that mutual funds also are a vehicle to invest in debt. They should continue to practice asset allocation. Anyone who practiced asset allocation benefited in 2023 and 22. They will continue to benefit in 2023 by doing either multi-asset or asset allocation. And do logical investing. Don't get carried away in euphoria. And I believe that it is not yet time to actually press the accelerator and take big risks. That time will come. And when that time comes, and if we get it right, we didn't get it right in June, but if we get it right, we will tell you. In March 2020 and April 2020, we were very clear and we did communicate. But in June 2022, we were not that clear. But we still believe we are in that middle of the road path, and that's what we think we are in. But Indian macro has been beautifully handled. India is a fantastic structural story, but against that we have record valuations, and that's the challenge.
Absolutely. It's a pleasure, Naren. Great to speak with you.
Wish all your viewers a very happy 2023.
Thank you so much.
And all of you at CNBC.